Okay, so today's I'm going to share with you a little knowledge about the one of the strategy which I'm using, and this strategy is called the CRT. Okay, it is called the CRT. That's the strategy we are going to discuss, and what you see is one of the tools that we're gonna be using, and the tool we are using is called the trading view. So you need to have a trading whereby it's easy or it simplifies for you to analyze the market. Any market, you can analyze here in market. You can find anything you want, okay? You can find anything you want and analyze it using the trading view. So where do we begin, guys? Where do we begin? First of all, we have to define we have now to define what is candle range theory, CRT. Okay, so candle range theory or CRT is an advanced technical analysis concept examines a range of candlesticks across time frames. Okay. By treating each candlestick in a high time frame as a representation of a complete range of price action on a lower time frame. So CRT provides traders with a framework to predict market dynamics. The theory integrates other influential trading concepts. It means when you understand CRT, candle range theory, strategy, it is not working alone. You have to add the additional CMC or ICT technology methodologies, particularly the ICT power of the three, okay? The power of three candles. So the PO3 model, okay, the PO3 model we are discussing here, it is let me share with you guys here. Okay, this is what I mean. 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 So the PO3 model means accumulation, manipulation, and distribution. Okay, this is the I'm trying to share with you guys. So you have to start from a high time frame and then go. So you get you examine launch or length of a candle or the power of three and the price combination of participants, buyers and sellers, how they move the price. So CRT is especially useful when combined with multi-time frame analysis. So you start from the higher time frame, going down up to the entry. So it depends on which type of trader you. Okay, it depends on which type of trader you. Are you a day trader? Are you a swing trader or a scalper? Okay. So for me, I will just focus. I'm a trader, so I will just focus on day trading, multi time frames. Okay. So higher time frames gives the market context, and the lower time frame offers a precise entry signal. So for day trading, it means we'll be focusing on uh uh focusing on day time frame, 1 hour time frame, and our precise entry will be on the 15th or a refined time, which is 5 minutes. Okay. Now, so what do we pay attention here? Okay. So key trading sessions. Now, what are the key trading sessions? And specific timing, such as the overlaps between one market to another market. So the key trading sessions we are discussing here, the key trading sessions is something which also you have to pay attention when dealing with the power of three. Okay. You have to also when okay, uh, uh, important. Now we have time, yeah, between one session. Yeah? So also you have to identify the specific time. You have to identify the specific time between one session. That's very much important to focus. Okay, very much important to focus. The overlapping time is very much important to focus. All right, so the sessions play identifying a variety CRT pattern. So this comprehensive article explores all aspects of the candles. Yeah? Now, as is a concept in technical and price action trading that focuses on the range represented by a candlestick high and low price levels. Okay, so we are analyzing the market from the higher time frame. For example, yesterday I was just analyzing I was just analyzing what? I was analyzing Ethereum. Okay, I was analyzing Ethereum, and if you want to know properly how to use the sessions, there's this indicator here. Just go to your, just go to the indicator button here, and then look for something. For this one here is called FX Market Sessions by Boytok. Okay, add this indicator, and it will be useful for you to understand what? To understand the sessions. Or you can just go and use and search for this sessions by Laxi Argo. Okay, sessions by Lax Argo. You add this. So you just come in and search, you like sessions, okay, and then you sessions by Lax Argo, or you FX market sessions by Boytalk. Okay, now this is very much good. Okay? Why? Because it will help you to know what time frame. I mean, to know the trading. I mean the session for you. Where I mean at what time the Asian session starts, opening and the closing, then a new session, then the specific time, which is the overlapping between one session and another session. Between one session and another session. So these are the most important things that I have to consider. Okay? So price does not move arbitrarily within the range of a candlestick, okay? Rather, it follows structured patterns that can be analyzed for predictive insight. So CRT, or candle length theorem, is built on the premise that the price sweeps, repeats, breakout, or retest the high or low of a candlestick range. Okay? Yes. Liquidity sweep, breakout, and the retest. Okay? The high and the lows. That's how the price is moving. Okay? So this behavior reflects the ongoing process of accumulation, where institutional buyers accumulate positions. Manipulation, where price action temporarily misleads retail traders. Okay, so accumulation you can name it as consolidation, or the market is just lending. So as a trader, you expect a massive move, an impulsive movement after accumulation, either bearish or bullish. Okay, so accumulation now is for the institutions, the institution buyers, the big players in the market. They accumulate, and then manipulation is whereby the retailers are being trapped and misled. Okay, and the distribution where a trend is established. So when you say manipulation, you mean liquid. Okay, accumulation, consolidation, either bearish or bullish. And when you say manipulation, you mean liquidity. Okay, liquidity sweep. Then distributions, now a trend is going to be formed. So CRT works perfectly during a trend, and they don't trade it when there are news. Okay, don't use it when there are news. Okay, so we are looking for a trend establishment, and institutional positions are distributed to the market. What was being accumulated now are being distributed to the market. Okay? So so during accumulation means price is very much stable. Okay, price, the market is moving sideways within a confined range. Is it right time for you to trade? You don't trade during accumulation. Okay, don't trade during accumulation. Even don't trade during manipulation, but you need to trade during distributions. Okay, why you don't trade it during a manipulation? Because in this trade, the market temporarily breaks out of the establishment range in order to lure retail traders into false positions. This fake movement is often designed to trap traders and create liquidity, which is then used by institutional participants. So who does the manipulation? The big players, the institutional participants. Distribution following the manipulation phase, the market enters a distribution phase where major institutions distribute their accumulated positions, leading to a clear directional move that often confirms the underlying trend. So you should always trade during a trend. Okay, you should always trade during the trend. Now, what I can just say so far, let's go now and see how do you recognize key CRT candlestick configurations. Okay, so the identification of CRT patterns is a critical skill for traders hoping to capitalize on predictable market moves. CRT patterns are characterized by the interplay between the higher time frame candlestick range and the smaller time frame price action that occur within it. Specifically, traders look for key patterns such as number one, alarming patterns and inside bars. Now, let me explain here, guys. For example, this is where I've already added in my session indicator, okay? An indicator, a helping tool that can assist me to identify the session. So right now, this is the first candlestick for, this is Tokyo. This is the beginning of Tokyo, okay? As you can see, this was New York session and this is Tokyo, okay? So this is Tokyo. Remember, Tokyo start from 2 a.m. Tanzanian time to 11 a.m. East African time, okay? That's where the London sessions stop. So London sessions overlap, Asian session overlap London between 10 a.m. to 11 a.m. That's the specific time, okay? The specific time, the overlapping time, okay? Now, this is Tokyo now, okay? This is Tokyo. Now, what is the time already? This is 4 hour time frame, okay? This is 4 hour time frame. I said you start from the daily, then you can go to 4 hour time frame. Now, I want to show you how do you identify these. So let me use another, for example, let's do this. Now, this is a candlestick, and let's assume this is a bearish candlestick, okay? A bearish candle, a bearish candlestick. And you have here your wick. Okay, let me do like this. And then you have here something like this. Now, listen to me very carefully. So this is how it goes, guys. This is how it goes. This is how it goes. So this is bullish candlestick. Okay. Now it's a daily. Now I'm going to say this is a daily candlestick. Okay. I'm gonna name it as a daily candlestick. Here I say this is a daily candlestick. Okay. This is a daily candlestick. Now, what is this one here? This is a daily candlestick, a bullish daily candlestick. Now, we are looking for what? We want to identify the range. So this is where the market started. The market started from this point, ladies and gentlemen. The market started from this point. Now, we're going to name this as our opening price. Okay, this is the opening price of the market. But when the market opened, it did like this. When the market opened, it did not just open here and start going up, price moving up. Rather, it started here, but it went up this low. So we say this is our opening price low. This is our opening price low. Daily opening price low. Huh? Daily opening price low. Daily opening price low. You can name whatever you want to name. Okay. So this is where the price started. The opening price started at this point here. But what it did, it was like this. It started here, but it did not go up. Rather, it just did this. Yeah. Okay. And then it came back like this. and then it came back like this, and then it came back like this. Okay, so it went like that. Then what it did, it just went up again, just went up again. Okay, that's what it did. Now it means we have now our opening price, and we have our daily opening price low. This is how low price went after just started here, then it created a low. So we have the opening price and we have the low price for the day. Now identify the closing. So where did the price close? The price closed at this level here. This is our closing price. So we say this is our closing price, and I'm gonna name it as closing price. Okay, daily close price. Okay, that is our closing price. But before that, during the open. Okay, what they did like this, then coming here. Okay, then coming here, then created closing, daily closing high. Okay, daily closing high. So this is our daily closing high. Daily closing high. This is our daily closing high. Okay, this is our daily closing high. This is our daily closing high. Perfect. So now you have understood how to do what? You have understood how to identify highs and lows for a bullish candlestick. That we have the opening price, we have a closing price, we have the opening price, we have the opening price, we have the closing price, and then we have the closing price high. This is the range. Now, this is the accumulation. Okay, the power of three model. Now we are on the accumulation. So the first candlestick will give you the accumulation. Okay, the accumulation or the range means price will be traded within this range in a day. Within this range in a day. So we have already identified our accumulation. So what next? So now if you look the patterns, these patterns involve a small candle forming complete within the range of a previous larger candle. Inside candles signal a period of consolidation and accumulation as institutional players build their positions. So here, if you go to lower time frame, you will see different multiple candles. Okay, now number two, you go and look for the manipulation candles. So this includes candlestick with long wicks that temporarily break out of the established range but then fail to sustain the move. Their appearance is indicative of a liquidity grab meant to trap retail traders, often preceding a reversal toward the actual trading direction. Now it is like this. So for now we have spoken about bullish. For bearish candlestick, let's do like this. Now this is our bearish candlestick. Let me change the color maybe. We say this is a bearish candlestick. Now we have our wick here. Yeah, this is our wick. Okay, and then we have another wick here down. That is the opening price. Now this is the opening price. And opening price for bullish was down, then the opening price for bearish would be at the top here. So this is our, so we name it is our opening price. Okay, now when you open coming to this low, no, it just had an opening price high. So we price high here. Okay, opening price high here. So we say this is our opening price high. Okay, this is our opening price high. Daily opening price high. Okay, now means we started here, but price created a high, then started moving down. Started moving what? Started moving down. So we close the price, a daily close. I mean, a daily close price is this one here. So this is our daily close price. So we name it as our daily close price. Close price. Now, before we close the price move a little bit low to create a low. So we have our daily what? Our daily close price low. This is our daily close price low. Okay, so we have seen now a bearish candlestick, independent candlestick, and a bullish independent candlestick. So we have highs and the lows for bearish, and we have identified the lows and the highs. I mean the highs and the lows for bearish and the lows and the highs for bullish. So we know now where is the opening price, where is the closing price, and what kind of a candlestick is. So the first candlestick among the three candlesticks you're looking with, the first will give you a range or accumulation candlestick. So this accumulation candlestick. Okay, let me delete this. Let me delete these ones here. Fine. So now, what you want to understand here? So it means accumulation is the Asian market. So the Asian give you the accumulation. Now, what you see on now, this is the Tokyo. Okay, so we have already identified our lows and high. Now we have the range. I mean, a 4-hour range. This is a 4-hour range. We have identified. Okay, if you go to daily, you will see also that we have a daily range. Okay, we have a daily range. Now this is our range. Okay, this is our range in a day. So we have. So on a day we have a previously day low, and we have a currently we have a previously day high, and we have a currently day low. Okay, we have a previously, we have a current. So this is the previous and this is the current. I will teach you how to do this. Now on a 4-hour time frame, we have this one here. On a 4-hour time frame, we have this one here. Okay, we have this one here, guys. So this was the Tokyo session, the beginning of the Tokyo session, which now it has given us an accumulation candlestick, the range. So it means in 4-hour time frame, this is the range that Ethereum is traded between 3725.64 and 3620. This is the range. So the second candlestick will be manipulation. Now, a manipulation, what does it mean? Now, this is our what? This is our bearish candlestick. Okay, this is our bearish candlestick. Means the direction of the market is downtrend. And this is a bullish, meaning the direction of the market is bullish. So for the bullish effect now, for a candlestick to do like this. So let's assume this is our what? Let's assume this is our candlestick here, down. Okay. Yes, like that. And then now we see something like this. Something like this. Taking this down. Okay? Taking that down. So that is our candlestick, yeah? That is our candlestick. Now, this is what you see now. So you need to see what? A long wick. Now, this one here is a wick. A long wick, break out. Break what? The low. Break the Asian market. So this is the Asian market. So you wait for a manipulation candle, which has a long wick, but temporarily break out of the established lane. This was the lowest range, highest range. So the appearance is indicative of a liquidity grab. So we say this is a liquidity grab or a manipulation, or some people they say liquidity sweep. What does it mean? Means to trap retail traders. To trap retail traders, often preceding a reversal, the actual trend direction. So we see a reversal means it will just take liquidity of this low, and then a new candle will be created now for a bullish continuation. Okay, for what? For a bullish continuation. Now means we have something like this. So price will come inside here and coming inside. Okay, price come here. Take this high. Take this high. So remember, this is our high. Sorry, this is our opening price. I mean our closing price for bullish, and this is our high. So price will come and take this high here. Okay, that's how it goes. So why? Because the liquidity means what? Liquidity means price has to go to where liquidity is. Liquidity is like electricity driving the market. So we have liquidity below these lows, and we have liquidity above these highs. So what it did, price, after that liquidation, after that manipulation, then you will see price come inside and take this high. So we will see again another something like this. Again, we will see something like this. The market will take liquidity again of the highs. Okay, again the market will take this liquidity of the highs, and then now we should expect what? If we should expect the price to drop down again. So this high here for bullish, this high, it is called the sell liquidity pool. And this low here is called buy liquidity pool. That when buyers, they put their orders here, okay, their stop losses are below this low. So that's why it is called the buyers, sellers what? So it is liquidity for these sellers who are selling at this high. And this one here, it is called buy liquidity side, because liquidity for buyer. That's where people converting or liquidation is taking place. Okay. Same thing to bearish. That we are expecting to see what? We are expecting to see something like this. Okay, something like this. We expect to see something like this. This is our high. Don't forget, this is our high. Okay, and this is our opening high. So what do we see here? We see a manipulation like this, taking this high, and then we're gonna see a continuation now of what? Continuation to the downside, a continuation to the day candle price low. And then here, what we see, we will also see a liquidity grab of these lows. That's how the market moves. That's how the market moves. So let me put it like this. The colors are the same here. I hope with these drawings, you have understood how the market is moving. So this is how the candle length theory is all about. It's about manipulation. It's about accumulation, which gives us a length. It's about manipulation, which is the liquidity grab, and then distribution or expansion. Okay, distribution or expansion. Same thing to bullish, bearish. Bullish, bullish direction. We have the money accumulation, which is done by institutions, and then manipulation. Okay, trapping retail traders, and then a distribution to where? To the highs. Okay, to the highs. Now, not all the time. Sometimes the market, for continuation, you might see it will take liquidity and then break out this high with a full. Well, let's say if it does like this, that is something else again. This is a continuation. Don't claim. If it does like this, this is something else. This is a continuation, guys. Okay, this is a continuation, means then market is moving, still continue going up. Still continue going up. So these lows and highs has to be done by the week. So now this can be when? If it's a day, now you have to understand. This can be a day gives you 6, if you're trading 4-hour time frame, a day gives you 64-hour candles. 6 4-hour candles. Okay? For a day. And then for 4 hours, it gives you 4 1-hour candles. So you can go to 1-hour time frame and then look for 4 candles and look if you have a range, you have a manipulation, and then you look for the distribution. Okay? You look for the distributions. So, step number 1, identify support on higher time frame. Okay, identify support on higher time frame. Now, a key support level. Okay, we call them the point of interest. The point of interest are highs and lows for both direction, supply and demand. Okay, those are the point of interest. order block, okay, are also point of interest, and the fair value gap. Also, those are the point of interest. So identifying the support on higher time frame. So at a key support level, the higher time frame can form with a well-defined high and low. The range of this candle becomes the benchmark for the day. So this is our support level, okay, and this is our resistance level. This is our support level, and this is our resistance level, okay. Step number 2, observe the lower time frame action. So you go to a lower time frame, switch to a lower time frame. For example, you can switch to 15 minutes chart, where you notice that the next candle grabs the low of the previous candle and the closes above it. Okay, the low and the closes above it. The behavior signals that the market is respecting the support level and it begins to accumulate. So you go to lower time frame to look for what? For a change of character. Okay, so when we say change of character, it's the first change in price in a market structure. It's a change in price. It's the first change in price in a market structure. For example, the market was just moving this low. Okay, it was just moving like this. The market was just moving like this. This was how the market was moving. Okay, the market was just moving like that. Okay, this is how the market was moving. So now this was our high and this was our low. Now this will be our lower high, this will be our lower low. Okay, and then we're gonna have another one here, which is what? Our lower what? Our lower high. Again, we have our lower low. So this we say is a bearish movement. Okay, it's a bearish movement. So now we have we had a price level here, 39.50 for example, and then now you have 38.72. So now you have this 39.14. So this is high than this one. So this is low, this is high, but this is more higher than this one. That's why this is called the higher high. Then we have lower high. Okay, I mean, we have higher, we have low, and then we have lower high. So this can be higher high, okay, and then lower. Okay, so now you have this one here. You have this neckline here. That this level of price was being blocked. This level of price was being blocked. Okay, this low has been blocked by the price movement. What does it mean? Means now this was our low, 38.70. Now this is our low, 38.21. If you compare 38.70 with 38.22, which one is lower? 38.22 is lower. Okay, 38.22 is lower. Now, if 38.22 is lower, then this is called an impulsive movement. This is called a collection. This is called an impulsive movement. Okay, a strong movement that is breaking the law. And markets will not just go like this, it will just do a collection. Now, a collection can be either touching this low or just go inside here, and then do like this, continuing breaking this low again. So now we are learning smart money concept, breaking this low again, okay? Breaking this low again. Now, how many breakouts? 2 breakouts. Now, this confirms a validity trend. A validity trend consists at least 2 takeoff structures. So we had a structure of moving down. But what happens now? What happens is when we were here, we saw something like this. We saw something like this. Okay, something like this. If you see something like this, a little bit here, okay, and then take liquidity, we grab this liquid, break to structure. It has to be by the full body, not by the wick. So it has to be by the full body, like this, by the full body, not by the wick. It should not be like this. It shouldn't be like this. It shouldn't be like this. It shouldn't be like that. It has to be by the full body to break the law. The law should be broken. If it is like this, then we consider it as the manipulation. Okay, we consider it. Now, instead price to continue, then we see what? We see a manipulation taking place, then price does like this, coming and take this side here. So now we had, this was our liquidity. This was our last change in price, but we didn't see a continuation. Then we saw this one here. We saw something like this. So what do we say? We say this is our first change in price. So we have this low here, 37.72. Now we have this high, 38.02, and then we break a little bit. We take liquidity, but we came and break this 38.02, now a new level, which we also break this one here. So now we have a new level. We have breaking how many levels? 1 and 2. So now we have changed the direction from coming down, from having a downward direction. Now we are going to have an upward direction. Okay? Now we're going to have what? An upward direction, like this. We're going to have an upward direction. Okay? An upward direction, like that. So now this one you have to go to lower time frame to get the confirmation that yes, price movement as respected our low as our support level. And then now we go to lower time frame to look for confirmation. In a 15 minutes, we want to see a change of character. At least 2 breakouts of structure. And then now we know we have changed the direction. We are on a bullish trend. Okay, I hope I'm making myself very much clear on this. Let me delete this. Let me take this out. So look for a 30 candle that manages to close above the high of the candlestick that initially grabbed the liquidity. This is the one which grabbed the liquidity. Okay? So you need to look for a 30 candle. Always make sure the 30 candle is above, close above the high of the candlestick that initially grabbed liquidity, or indicates a strong change in market structure on the lower time frame. This sequence forms a clear bullish candle range theory pattern, suggesting that the market is transitioning toward a higher trending range. Okay, a higher trending range. So now let me share the time frame combinations. Let me read this and share the time frame combinations. So it depends on the type of trader you are. As I said, that if you wanna analyze, you wanna see the big picture, you have to start on the higher time frame. Okay, you have to start from the higher time frame. Any question before I proceed? Any question? Any question before I proceed?
Hello, good morning, sir.
Yes, Sandy, you have a question?
Yeah. Yes, I just joined now. I've not knew that there was a
I can't
meeting.
hear you, or you can light it down. I can't hear you, brother.
Okay, I will write down, but can you hear me now?
I cannot hear you, bro.
Okay.
Morning, brother. How are you doing?
I will write it. Maybe continue. I will write my questions down.
Yes, proceed to the question. Okay, fine. So now you have to backtest this. You have to do a lot of work to make sure that you master. You need also to backtest it until you understand. So when you're analyzing the market, you start from time frame, going to a lower time for the entry. And we say that the first candlestick gives you what? It doesn't matter. It can be a 1 hour time frame. Doesn't matter. But at the end of the day, the first candlestick gives you a range. It moves in a range. If you see that range has been blocking out, means there is a continuation. Okay? If it's broken down or up by the body, means there is a continuation. But even down by the wick, it's just a manipulation candle. So you just look forward for an engulfing candlestick. That candlestick, the third candlestick should be higher than the previous candlestick that holds pressure. Okay? Now, for the time now, a monthly CRT was the daily setup. So you use the monthly candle length for overall market context. Then you focus on a daily pattern for trade entries. If you are a swing trader, okay, for long-term trades. If you're a long trade, that's what you can do. For daily CRT, 1 hour is your setup. So a daily range provides context and you capitalize on a 1 hour candlestick setup for move precise entry points, and you can go to 15 minutes. Okay, 4 hour, 15 minutes. Like we're doing here right now in Ethereum. You see now this is a 4 hour time frame, and we have started a new candle. This is a new candle within a range. So it's not necessarily to have only 3 candles. It can be much. Now, you see now, this is our high, daily high. Okay, so this is our 4 hour. What kind of candlestick is this? Okay, this was bearish. So this low, and this is our high. Okay, this is our low. Inside the bar, within our established, take the low or the high. It's a bearish. I mean, it's a bearish engulfing candlestick. Okay, by the body. you have another formation which has been formed right now. So we have started London because London starts at 11 a.m. Eastern time. Now, this indicator which I've shared, it indicates Asia is you money accumulation. Are accumulating positions. Now they have accumulated positions. Now London has to give us what? Has to give us a manipulation. So we are going to see a manipulation here down by the London. It will take this low. If it will be done by the week, it will take this low. Now our entry should be the third candle, meaning the third candlestick should be above, higher than the previous candlestick, which take the what is low, which is say to the black. So where should be our entry? Now let's assume if this candlestick will just remain where. Now when this okay, this be our because it can come here down, continuing what you see. This is what London does. Always the London session takes the Asia liquidity. So London is a manipulation market. They take it of the Asian here below. Then we look for the third candlestick. You can come down. Don't just place. You place. No. Be patient. You have 3 hours of studying, waiting, entry, disciplined, wait for this candlestick to finish its formation. So let's say it goes like this. So our entry. Now, once the 3 hours has been done, the liquidation has been taking place. So you go to lower time frame. You go to 15 minutes, looking for what? Looking for a change of character. So you will go to the 15 minutes and look for the candlestick that caused a manipulation, and then you look for an engulfing candlestick, a bigger candlestick that is covering the previous candlestick by the image. That's what you will look. That's what you will look. So your entry should always be where? Now you come and say, this is my what? This is my opening price. Bearish. So guys, of character, but remember, the lower time frame, it will just, when the market do the expansion, the distribution, it doesn't end there. Distribution has 3 phases. It has expansion, it has retracement, distribution, again reversal. So you go to lower time frame, 15 minutes, looking for a change of character also in a 15 minutes time frame. And you will look for an order block or a fair value gap. Now, I'm giving you this knowledge. So this will be your entry. Okay? This will be your entry. Okay? This third candlestick formation, that is your entry. Your entry what? Your entry execution. The third one. Now, not the third in terms of 1, 2, 3. No. The candlestick that caused manipulation. The next one, if is bigger than, let's show like this, should be taking this higher. Take this higher of that candlestick, which causes a manipulation. Now we have something like this. So what is this? What it does is a bullish distribution, but we might a bullish expansion, then we might see a retracement. So we focus on that retracement in a lower time frame. And that's where now you go to 15 minutes to see what 15 minutes is giving you. Okay. Now, if we go now to 15 minutes, look on the 15 minutes. Okay, on the 15 minutes, this is what it does on the 15 minutes. Now, here we are, guys. You see, London started where? London started here. Okay, London started here. This is our London, and we have seen a manipulation here. So what we are waiting here, we are waiting for a candlestick that will be attacking this high. If we take this high in a 15 minutes, now we will have a sequence of what? A sequence of candlestick here. And then, because we still have four minutes for this candlestick to be completed. We still have four minutes for this candlestick to be completed. Okay? So we say that for a distribution, look for a confirmation. Look for a 30 candle that manages to close above the high of the candlestick that initially grabbed the liquidity. Now, candlestick which initially grabbed the liquidity or indicates a strong change in market structure on the lower time frame. So you have to do that. You have to confirm it on a lower time frame, not on a higher time frame. That is number one confirmation. But the second confirmation should be on the lower time frame. So this sequence forms a clear change of market structure that now you are transitioning toward a certain direction. Okay? The certain direction. So this one here, I'm going to name it as a what? As our change of character. You just name it. It has not appeared yet. So you just name it as 15 minutes change. Some people like chop, or some people like the market structure shift. Market structure shift. They like that. And then you wait. Just wait. Just wait. But what do you see, guys? What do you see? We say he has taken this. Now there is something here because we still have 2 minutes. So you have to wait and see where is our body, our bullish body closing. Okay, will it close inside the established D, or it will just close the outside? But these things has to be close to the point of interest. Close the point of interest. Now, I was doing this analysis in a day and found a change of character here. So this was a change of character. I was doing this in a daily time frame and I saw a change of character here. So if you expand this, this is a very potential area. And we have our point of interest here down. Okay? This we mark this is our support level. Okay? So it has like that. What you need to do, you need to wait and see how this body, this initial candlestick which caused liquidity grab this low, is it still going down, or it will just be inside our establishment? Because this is our high, don't forget, and this is our low. This is our high and this is our low. 4 hour candle range high. 4 hour candle range high. And this one here is our what? Is our 4 hour candle low. Yes. So London was taking the Asian liquidity. London. So this is a manipulation. Asian is what? Asian is accumulation. Okay. Now you see a new what? A new candlestick has been formed. Maybe there is a continuation because we still have some liquidity here down. Okay, still have some liquidity here down. So you have to be patient. You have to be very, very much patient. You have to be very, very much patient. So your confirmation is this 15 minutes open price. 15 minutes open price. 15 minutes open price has to be broken. You are verifying if a higher time frame and a lower time frame speak the same thing. That's what we are doing here. Yeah, that's what we are doing here. That's what we are doing here. I hope you the screen is back and you can see our screen. So you need to be patient and wait. You need to be patient and wait. But now I'm adding you this. Once you have identified the high and the low, you separate the level, the equilibrium level, and the what? A discount level. Because we have liquidity of the low, means now our focus is to our targeted profit is the upper levels. So now you take what? You take your Fibonacci retracement, and then you take from if you go back to 4 hour time frame, it was high to low. So you take from low to high, from high to low, like this. Okay, let me do expansion like this. And then now you identify, you just mark this as what? 50%. This is called a retracement, that market can retrace 100%, market can retrace 38%, 50%, 61%, 78%, or 100%. Now, so you make sure that you mark it precisely. You mark it precisely. You make sure that you mark it precisely. Okay. Now, what you come here, you come and do this. You say, now, this is our 50%. So you mark it. This is my equilibrium level. So what are you looking? You are looking for what? You are looking for buy positions. Okay. So you mark it, and you can just maybe put a color like this, and then you delete your Fibonacci retracement like this. And you name this as what? As your equilibrium. I think it's like I've deleted something else. I want to delete what? I want to delete this, the Fibonacci retracement. Okay, it's taken out already. So now we have our 50 minutes. So you are 50%. So this is the equilibrium level of the high and the low. So you name it as your 50%. So this is what? Above 50, this is our premium level. Premium level means it's a level where price is very much expensive. Buyers cannot buy above 50. Don't buy above 50. You need to buy below 50. That's what you need to do. So above 50, this is the premium. So we name this as our premium level. Yeah, this is our premium level, whereby price is very much expensive. Buyers cannot buy. Even you cannot buy when price is expensive. You want to buy when the price is what? It's cheap. You have to buy when the price is cheap. So now this is our discount level. Okay, this is our discount level. This is our discount level. Okay, this is our discount level. So now we are looking for an order block or fair value gap nearest or below our discount level. So that order block or fair value gap has to be within our discount level. Within our discount level. Okay? Now, so what will be our first target of profit? Our first target of profit will be our 50%, because that will be the expansion. After expansion, we expect what? After expansion, we expect a retracement. After retracement, we see a distribution again, expansion, and then a reversal. Okay, and then a reversal. But so far, we have identified our 50%. This is the equilibrium. Already, we have our discount level, and the price is on the discount level. What we are looking here is just for a high probability entry. We are looking for a fair value gap within our what? Our discount level. Now, sometimes you can have more than two fair value gap. More than two fair value gap. You look the fair value gap that is close to the equilibrium. Okay, close to the equilibrium. That's where price will be. But sometimes does like that, sometimes does not like that, because it depends on which type of instrument you are trading. So this is the signal I'm giving you now. So we are trading live so far. Okay. Yesterday I was doing this trading, and I shared my target was around here. Okay. But we have made a lot of profit, guys. This was my entry, and see where price came. Price came to this level here of support, and now it's our resistance. And you see, even our 50% is within this point of interest, the one which we expect. So this will be our TP, and our TP2, it will be this, the 4-hour candle range high. Now you can leave it. You leave it. If you want to wait until the end of the day, price will just go coming back, coming up. You don't care. But make sure your stop loss is below this low. Okay? Because we have a low here. So your stop loss should be below that low. Okay? Should be below that low. Now, if you want to get a very precisely stop loss, there is an indicator called the ATR. Okay, this is indicator is called the ATR. So you can use it. You can use that indicator. Okay, you can use that indicator. You can use that indicator to do what? You can use that indicator to support you on identifying the stop loss. ATR. Okay, if you go to your indicator, search for something called the ATR, average true range. This one, average true range. It measures volatility of the market. Okay, with an average of 14 candlesticks, and then you will know how density price can go. So it will give you a very clear stop loss. And once you get your stop loss, means you have got your what? Your TP. Okay, your TP. Okay, so now you have to wait like that, so that you have to wait. Nothing you can do. You have to wait until things uh, come into your confirmation. So you should have a confirmation, and our confirmation is we have to wait for a bullish candlestick. It will go above this high, then it will come back reversal and create a fair value gap, and that will be our entry going up. So someone can say my entry will be here, so this should be your entry, but you cannot enter here. Why? Because when markets will come and take this liquidity here, because there is liquidity here, the liquidity stays in support and resistance, okay, highs and lows. That's where liquidity stays. So liquidity will be, it will just take and then come back down, and you go with a loss, even though it will be just a drawdown. So you wait for a precisely high probability. It will take this high and then retrace inside a fair value gap. Now you should wait for a fair value before that's where will be stop loss will be down here, and then you focus on this 15 minutes, okay, 15 minutes, or you take this high here. So it will be a 1 to 2 ratio, something like that. Okay, so far we are just learning, just guessing, but we have to wait. Now if you go to 4-hour time frame, look, if you go to 4-hour time frame, this is what you should see. Now you see, this is 4-hour time frame. This is 4-hour time frame. You see, I told you don't rush, because you don't know until you still have 3 hours. That's where now do the calculation. Right now it is 11:29. So what time will the 3 hours and 30 minutes be over? Huh? It will be 15. 15. Now 15, that's New York session. That's New York session. So New York session now will give us a distribution. So we will do everything on where? On our New York session. New York session, guys. Okay, on the New York session, that's where we will be doing our what? Yes. So this can just go, da 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 da, then coming, and it does its liquidation. So this can just go coming down, but what it will do, it will just remember this is a 4-hour candlestick. So each candlestick here represents 4 hours, 4 hours, 4 hours. But inside here, there are multiple candles. If you go to 1 hour, you can see it in a 1 hour time frame. You see, you in the hour time frame, you just remain with 29 minutes for this candlestick to be done. So 29 minutes means it will just coming inside maybe and create another candlestick. So if 1 hour we're gonna close inside, then the next candlestick hour will give us a clear picture, and our take profit will be done for the 4-hour time frame. The 4-hour time frame high will be taken by the what? By the next session. So 28 to wait. If you go to 30 minutes, let's see 30 minutes. You see 30 minutes is like that. 30 minutes like that. Shows like this. This is 30 minutes. That price did not close inside our establishment, rather it's just did like that. But our focus is this: if we're gonna see price go above this high 36.48, then we wait for a retracement to our order, then we move to the top. So what you see now, this one is the 30 minutes you see is a bullish. So it will just take this. And the reflection is this now. The reflection is what you see here. This now will start coming, squeezing up. If you want to see that squeezing up, you go to lower time frame, you will see bullish candlesticks being formed here, pushing. Its reflection, you see it in a full one candle. That price is being pushed. The buyers are pushing, buyers are taking over the market now, pushing price inside the what? The establishment range. And then we focus to take liquidity at this high. This will be our TP1, this will be our TP2. Any question? Any question, guys? Question? 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 Any question? Question, guys. I'm here. Question. If you have questions. 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 So accumulation, transition of accumulation to manipulation. So manipulation means uh, liquidity is increasing and the volatility is increasing compared to accumulation. Okay, so you pay attention to these times, key timings. You pay attention to this. You pay attention to these time frames here. Sorry. So the key times such as 1 a.m., 5 a.m., 9 a.m., 1 p.m., 3 p.m. and 9 p.m. have been identified as periods when CRT patterns are more likely to manifest due to shift in liquidity and market sentiment. So you can just back test this 1 a.m., 5 a.m., okay, 9 a.m., 1 p.m., 3 p.m. Okay, 3 p.m. So during this time, the market is either transitioning from one major session to another or experiencing a surge in trading volume. For example, the Asian session typically shows lower volatility characterized by accumulation, whereas the London session is known for sudden burst of volatility and a forced breakouts. This is what right now, a forced breakout. The London has a forced breakout. London session has given us a forced breakout. Okay, surge liquidity, indicative of manipulation. The New York session, on the other end, often represents the distribution phase with strong directional moves. Okay, strong directional moves. So to maximize the effectiveness of CRT strategies, traders should consider the following. Traders should consider the following. Session overlaps. That's very much important. Session overlaps. Session overlaps. Session overlap, sorry. Session overlap. Okay, so session overlaps focus on times when session overlap. Asian London. So Asian London at 1 a.m., 5 a.m. Okay, 1 a.m., 5 a.m. and London, New York at 1 p.m., 3 p.m. as these periods present the highest probability for significant liquidity shifts. When one marketing is closing nearest to close to the new market that is opening. That is called a transition of volumes, liquidity, volatility. Okay, so forced breakouts, be particularly alert during session transition where manipulation phases are common. Recognizing forced breakout is crucial for avoiding premature entries. Confirmation on the lower time frame, even during high probability times. Always seek confirmation on a lower time frame to avoid interlinked trades based on misleading higher time frame patterns. Very, very much important. You see, this is 4 hour time frame. I told you it will just being pushed by what? And then it will just be doing like that. It will just be doing like that. So on the 15 minutes now, you will see something amazing. Now you see what is being done now. We see this is our initial candlestick which caused that change. I mean that manipulation. Take liquidity. Okay, the London low. The Asian low was taken by the London. Boop. And then we saw, now this is what? Look here, guys. If you do this, are you allowed to do this? Yes, you can do the CRT in any time frame. Now, on the 15 minutes, we see what again? We have a range. This is our range now. This and this one here. This is our range in a 15 minutes. And we saw this inside bar, okay? Inside bar, and then how many minutes? 1 minute have remained for this to clear that we had a what? A manipulation. So this will be our manipulation here on the 15 minutes. And if you go to 5 minutes precisely, you will see something again, another narratives. Now look, on the 15 minutes, this is the range, established the range on the 15 minutes. We have our high here. Okay, this is our high. And now we have our low. You see, this is what? A candlestick that caused a what? A manipulation. Now we are focusing on this high. So we have to wait for a candlestick to take this high here. Okay, we have to wait for a candlestick to take this high. Easy like that. Easy like that. We have to wait for a candlestick to take that high. To take this high. Okay, because, and this is our low again. You can be playing with this as you want. You can be playing with that as you want. Okay, now you see our high now is going to be blocking. You see, it is blocking now, but we have to wait. This is okay. Let's wait for the yes. Now we're gonna see a new candlestick. Okay, a new candlestick. Which now see, we have seen a blocking. Yes, we have seen a blocking. Here it is. We have seen a blocking, guys. Here, You see, it is broken by the body. Now we have a new candlestick. But if you look properly, now we have a new candlestick, which is still going up, but we saw this high being broken. Now we have what? You come inside here, you look. If you come inside here, you look properly now. So this was our last, this is our low. We can say liquidity being grabbed on a lower time frame. Okay, and where is our fair value gap? This is our fair value gap. You see our fair value gap? This is our fair value gap. So, do you think price can come down? No, because this one, let me tell you, because this blockout was done by the body. If it could be done by the week, then we could have come down again, either to 50% as a retracement. Remember, don't forget to measure. You have to measure the retracement, that if it comes down, where will it come? Where will it end? This is our what? This is our prices here. Okay? So it can either come to 50% or 0.382 here, around here. That's where it can come. Okay? But you measure that, okay? Let's assume if it comes to this level here, okay? If it comes to this level here, this is my 50%. That's my 50%. That's my 50%. But already we have a fair value gap. So this is our fair value gap. And what is a fair value gap? It's a gap between three candlesticks. 1, 2, 3. There is a gap. You see this and this. There is a gap here. And it has to be filled. 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 But it has to be inside what? Inside our, it has to be inside there. So lower time frame, yes. Now you see on a lower time frame, this candlestick here is the one. Okay, this one is the one, which is initially the cause of this breakout. This is the first one. Okay, this is the first one. So now look here. If this was our last liquidity grab, then this was our high. This was our high. So this high has to be taken. Okay. For a change of character to happen, you need at least 2 break-off structures, at least 2 breakouts to confirm that there is a change of direction of the market. But already we have our fair value gap here. Already we have our fair value gap. So we're gonna say this is our fair value gap. This is our fair value gap. Okay. Now, if you go to, so if this was our 15 minutes, okay, if this was our 15 minutes high, so this was our 15 minutes low. This was our 15 minutes low. Okay, this was our 15 minutes low. And if you use the Fibonacci retracement, now we are looking for what? We are looking for what? We are looking for a 50% to know the what? To know the, and this is our 50%. You see? Exactly where. So our fair value gap should be the one close to our 50%. Close to our equilibrium. Close to our equilibrium. So I'm going to delete this. Now, if you go to 4-hour time frame, you will see it has completely changed. Price has been a fake breakout. We have seen a fake breakout. Okay, we are going to see a fake breakout, and we see a very long wick which has manipulated this low. You see, price is still being pushed inside the establishment range. Yes. And there is a, if you look on this, also this one here, it has not yet defined. Let me go to 5. We see if it has already showing the indicator for buying. So 1 minute and 50 seconds have remained. Now we need to see a breakout of this 15 minutes. I mean this equilibrium level. So we will break out, and then we will confirmation, which is our fair value gap. And once we get our fair value gap, which is nearest, if it will be this one here or another one, but it has to be nearest to our equilibrium, then it will be our entry. If it will be this one here, then our entry would be here, focusing this 10 minutes to 6, and our stop loss will be below here. Okay, our stop loss will be below this low. Okay, 30 points, which is $3, and so it's like 1 to 1. This is our sorry, not there, here. This is our what? Our TP1, or we focus to the higher time frame. We focus to the higher time frame. So we still have time to watch. This is how you do, guys. Easy. And I've been getting some good results, amazing results by doing this. You need to analyze the markets like this, and you need to stick to your plan like this. So what you need to understand after analyzing, always you need to do the risky management. How do you manage your risk? That's another thing. You can understand all of this, but if you fail on how to analyze the risk management, then these ones is useless. It is useless. So on the risky, you need to understand your capital. You need to understand the lot size you are going to use. You need to understand your take profit. Your take profit. So for you now to calculate the risky, do this. We say risky is equal to what? Risky is equal to entry minus loss. I mean the low entry minus the, for example, let's assume I'm doing this. I'm saying I will take my entry maybe around here. Now my stop loss will be below this low here. So now I have this. And my TP maybe will be 1-to-3 ratio or 1-to-2. Okay, 1-to-2 ratio. That I'm going to lose 1, but to make 2. Okay, 1 to make 2. Now, so now this will be my stop loss. So I will know my entry will be this. So if I take entry minus the stop loss, then I get a risk. For me to know my reward, which is the profit, then I will do the same. I will take entry minus the profit. Then I will know my reward. Minus profit. Okay? Then I will know what? I will know my reward. So to get the risk reward ratio, then I will just take my risk divide my reward, and then I will know the ratio. But 1-to-2 is very much good. 1-to-3 is very much good. But as a starter, go with 1-to-2, 1-to-2, 1-to-2. You get out 1-to-2, 1-to-2, get out. Size for the lot size, go with 0.01. Why? Because when converting lot sizes, we have almost like 3 days macro, medium business and small business. Okay, standard size, which is 1 lot size. Its lot size 1. You say standard like this. Standard lot size is 1. So if you want to convert this in dollar, this is $10. $10 per movement. A lot per move, per price movement. Okay, per price movement. Okay, per a price movement. So this is for big business, that for every price movement, if you are using one lot size, no, the profit is $10, the loss is $10. Just know that. Now for for medium, if you go medium lot size is 0.1. 0.1, this is $1. $1 per pip. That for every one price movement, you will be charging $1. So if it's a loss, I'm losing $1. Okay. For $1, sorry. Okay. $1, okay. So for small now, for small size 0.01, this is how much? In terms of dollars, this is $0.1. So how do I know this? Easy, guys. You just, for example, one, just put 2 zeros in front of this one. So it will be 100. Now again put, so it is 0.100. Now if one, then point to the next number. It will be how much? 10. Okay, it will be 10. So it is 1 point. Size, lot size 1, so it's 1 point. Like this. Let me do this here. Just to show you how you don't need to claim, you just need to understand. For example, when you say 1, so it is 1.0. That's the meaning. So for me to convert it to dollar, then I take this decimal place to the next zero here. So I take this decimal to the next zero. So it will be 10. 0. That's the meaning. So if it is 0.1, then I take this decimal to 1 here, it will be 1.0. If 0.01, I take this decimal place, the next one here, it will be 0.1. So this is how it goes. So for small accounts, $20, $100, $50, go for 0.01. That for every movement, either it's a profit movement or loss, you are being either losing $0.1 or you are earning $0.1. This is very much important to understand. Very much important to understand. So risk, you take entry minus loss, you get the number of pips. So here you get the number of pips. Reward, entry, profit, get the amount of pips. Let me, yes. You get is equal to pips. Okay, is equal to pips. Same here. Is equal to pips. Now you see, this is 4-hour time frame. Already price has come inside what? Price has come inside our establishment what? Sorry guys, establishment what? Range. Price has come to our establishment range now. You see, it is inside our establishment. So we go to 15 minutes to see for our fair value gap. You see, to our fair value gap. For example, so far, if you go to 15 minutes, you don't see any fair value gap here. You don't see it. Why? Because we have not taken this high yet. This high has to be taken, then the price has to come down in the form this a fair value gap, then we will have our entry there. But if you go to 5 minutes, you will see it. You will see it. You will see it. Remember, it was this one and it has been tested. So now we are going to see this one has been tested already. You can see our fair value gap has been tested by this candlestick here, and we see a very so our you see now we are moving. So this one here will create a fair value gap now on the 15 minute. I mean, remember this was our what? We said this was our high on the 5 minutes liquidity. Okay, so now this is how we do. Now we have a very long candlestick above our what? Our what? This. Our 15 minutes. If you go to 15 minutes, you will see this was the candlestick which take liquidity on the 15 minutes. So we were focusing on this high. Now we have something bigger than the what? The previous candlestick. Now, this is a confirmation that, yes, good on the 5 minutes, but what about the 15 minutes? So now we are going to have our first change of character, and then we will have a break of structure, then coming inside to our fair value gap, close to our equilibrium level, and then boom, we go for good. So someone can enter here, someone can wait for this 15 minutes, market surface shift to be taken away, then price will reverse, retrace back, then we are good to go. Easy money here, guys. Easy money. So you need to back test this. You need to understand this. You need to rewatch this. Any question? Any question, traders? Any question?
Hello, sir.
Yes, Sunday.
Hello, sir. Can you hear me now?
Yes, I'm listening.
Okay. All right. Thank you for the nice presentation. You analyze well. God bless you in the first place.
Pardon?
Okay. My question is, when we are looking for a manipulation candle, that means apart from the second candle that formed, manipulation can occur in any other candle. If we cannot find the manipulation in the second candle after our CRT candle, So any other candle, maybe the third candle or the fourth candle, can be a manipulation for the CRT to work. Or must
Yes,
the
but it has
manipulation
to be
be
taken exactly. It has to be taken from the higher time frame.
okay?
I mean, when you say that I'm analyzing from the day, and it has to be taken from the day, or it has to be taken from the 4-hour time frame.
Okay. Then what about up to like 15 or 5 minutes time frame? What if the manipulation is on the lower time frame? It's not a valid CRT setup, right?
No. It has to be taken on the higher time frame. Then you go to lower time frame now for confirmation.
Okay. 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 That
It's like
means
what I was doing here. If you
mm,
go to 4-hour time frame right now, see, let's go to 4-hour time frame. What do we see? You see, price was, I mean, the body was below this low, but now it
yes.
has come back inside the hour of the
Yeah.
4-hour candle range high, 4-hour candle range low.
Okay.
Are we together?
Yes, sir.
Yes. Proving that now this was a fake breakout. Proving that that was a fake breakout.
Okay.
Are we, brother?
Yes, sir. I'm with you, sir.
Sunday?
Yes, sir. I'm with you, sir. It's like
I
network
can't
is
hear
low.
you.
But I can hear you clearly. Maybe it's network
I
from your
cannot
end.
hear you.
Okay, let's proceed now because I can hear you. I think maybe it's network from your end. Let's proceed.
So we still have 2 hours. So this one will be completed in 2 hours. By the time it is completed, by the time it is yes. So now you can see price this was a fake breakout to a first breakout to what? To daily traders. So you need to identify the first breakouts, pretty premature entries. You understand? So don't forget to switch to a lower time frame for precision. Okay, transition to a lower time frame such as 15 minutes or 5 minutes to monitor for a candlestick that grabs the liquidity at the support level. The bullish setup occurs when the next candlestick closes above the support level after having touched it. Wait for the candle. After the liquidity grab, wait for a subsequent candle to close above the range's high or signal a market structure. For instance, confirming the accumulation to manipulation transition. This confirmation validates the bullish bias and indicates an impending upward move. So in trade, initiate a long position once the confirmation is established. The entry is from an order block formed on the lower time frame, using the identified structure as the reference point. Okay? So now if you go to 15 minutes here, let's see. Sorry. Now you see. So we are still waiting. But if I could have entered here already, I'm still on profit. Already I'm still on profit. But don't enter to avoid the premature entries. So sometimes we are losing because we are entering very early. It is a premature entry. It was not a valid confirmation. Because this has to be taken. Remember, this was what? So we have taken this low. Now we have a new lower high. This is a low. We have taken this, so this is a low. Now we have a new. This was a low. This was a. I mean, this was the. We have a new lower low, and this was the what? Another lower high. Now we have another higher price than this one here. So you see, this. If you will take this, we are looking for a serious candlestick to take this one here. So this is our break. I mean, change of character. Then he break. Because remember, he said to see a change of direction, you need two breakouts. So now we have the first breakout. We are still waiting for the second breakout for the confirmation that yes, we are moving. Then the entry is typically from an order block formed on the lower time frame using the identified structure as the reference point. And to define your stop loss, place the stop loss below the low of the candle that grab liquidity or below the marked support level. Okay? So which one, the one which grab liquidity is, okay? This one is the one which grab liquidity. So we will press, when we take our entries, we will press below this one here which grab liquidity. So our stop loss will be there, or you can take it below our support level. This was our support level. So below. So for taking profit targets, aim for the high of the original higher time frame candle or the next liquidity level that aligns with the distribution phase, which we said it can be our 50% equilibrium. Then market will retrace, then focus. If you need to, just don't worry, then you just leave it, then it will go to the highs.
Hello, sir.
Okay, question while we are still waiting.
Okay, can you hear me now? Hello, sir. No, it only told me. I think. Hello, sir. I'm not going to time. Go for me. Hello, sir.
Any question?
Sir, can you hear me now?
Now, someone can say, with this, can we make losses? In trading, losses are inevitable, guys. That's why we said your first TP should be what? I said your first TP should be. Yes, I can hear you now, brother. Let's proceed.
Oh, can you now, sir? Sir,
Okay, so key profit target is what ratios. Profit target should reflect the realistic price objective based on the higher time frame candle range. Many traders aim to achieve at least 1, 2, or 1 to 3 listed reward ratio, ensuring that the potential reward justifies the risk taken. One common method is to set multiple take profit levels. One common method is to set multiple take profit levels. For instance, first target at 50% of the high time frame candles range. Second target, the high for bullish setups or low for bearish setups of higher time frame candles range. This tidy approach not only capture profit during every favorable move, but also allows to lock in gains. You have to lock the gain if the market reverses unexpectedly. Anything can happen in the market, even if you have the best strategy. But you should always be ready how much willing to lose. That's the most important thing. Any question, guys? Any question? Any question?
sir, I have a question now, but you cannot hear me. That's the problem.
Any question? Any question?
Sir, I have questions. If only you can hear me.
Jerry, Bernard, Sunday.
Sir, I have some questions, but you can't hear me now. That's the problem. Maybe I will write down the questions on the chat board.
Question, guys, if you have questions. 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 Sunday, do you have a question? Question leaders, question traders. Question. Sunday, question, guys. Sunday is asking, sir, if the previous day candle is engulfing by the current candle, covered by both the upper and the lower wicks, can it still be used as CRT strategy? I don't know, because maybe you came late. Because I was explaining from the candles on how to identify any, a range, a manipulation. So after this, we watch it again, the video. Of course, technically, it has to be not more than everywhere, but it has to be and the range doesn't. I mean, the CLT range doesn't matter the candles. I mean, it doesn't matter the color of the candle. So it can either be the consistent of 3 candles or multiple candles. What you need to see the high, the low, and manipulation. If any manipulation you see within the ranges of those candles, then you see this is a manipulation. You draw your high from the previous, the low of that candle, and then you know this. Now I'm looking for a change of character for bearish or for bullish. Yes, you wanna speak? Sunday, what are you trying to say?
Lisa, can you hear me now? Lisa.
Anyway, so to make this video short, I'm going to stop the video and I'll be sharing, but this is how it has to be. Okay, guys, thank you so much for being here, and I'll keep sharing this on the group. But this is how you are supposed to do, and this is how you are supposed to wait. Now you can see now. You cannot trade everything. You need to analyze the market. You need to at least maybe 1 trade, 2 trades in a day. It's good. Okay, 1, 2 trades in a day is good. All right, thank you. And I will upload the video on the YouTube channel, okay?